Roth IRAs to convert or not to convert? That's the question. And that's what we're going to answer here today, my friends. We're going to go dive into this article that changed my life as a financial planner from the May to June 2007 edition of the Journal of Retirement Planning. I'm just going through a bunch of stacks and stacks and stacks of articles I've printed off over the years and throwing a bunch out, reading some, and I'm going to share some with you here. So this is probably one, if not one of the most important things I've ever read in my professional career. So stay tuned. Sorry about the the lack of prettiness, shall we say? But as you can see here, I got my little thing. Look at that. That's fantastic, isn't it? It's only day 3. I can't believe I got this on for another 5 weeks and 4 days, but who counting? Nuts. All right, so this is from Robert Keebler of May and June 2007 of the Journal. What was this? What I said, the Journal for Retirement Planning. And let me actually get up here and see if I can't make it bigger. I guess I can make it bigger someplace. There we go. Sweet. And I can read this to you because I got my copy here, and I've highlighted it many times over because when I read this, I was like, oh. This and Ty Bernicki's article from the Journal for Financial Planning in 2005, it was like when you first get told, a good story in the Bible. You know what I'm saying? You're like, oh, it just makes sense, and it was nuts. So here, Robert Keebler weighs the considerations and whether to convert to a Roth IRA. 2010 will present an unprecedented opportunity for this planning in the right circumstances due to the elimination of the current AGI limitation and the ability to stretch the income tax due on the conversion over a 2-year period of time. So this last part is over. You couldn't do the 2-year conversions anymore, but the AGI limitation is gone. So as you know, back in 2010, that was at the sun. I can't remember, but 2010 with the sunset rule, I think the AGI limitations were gone away for your ability to make Roth conversions. All right. Let's see. I want to start with in 2010, the world of IRA planning is about to change dramatically. As we near this date when qualifying income limitations are eliminated, every client will be proffering the same question. Should I convert to a Roth IRA or not? Now, even though we no longer have the 2-year tax payment as we did back then, it's still the same question. Should I convert or not? Unfortunately, the answer to this question is both mathematical and political. In order to be competitive, financial advisors, lawyers, and CPAs will need additional training and better software to help their clients answer this multifaceted question. All right, so then we're going to skip over here, down here. In 1997, I wrote a CPA's guide to making the most of the new IRAs, the Roth IRAs, which were passed back then. I identified 8 reasons why someone should convert to a Roth IRA. 2 of the reasons no longer apply. The remaining 6 are still valid today. To take advantage of favorable tax attributes such as charitable deductions, carry-forwards, net operating losses, carry-forwards, investment tax credits, suspension of the lifetime RMD rules. The payment of income tax prior to the imposition of an estate tax allows for greater wealth to be transferred to future generations due to the fact that no income tax is allowed for state death taxes levied on IRAs. We'll talk about that here in just a second. Greater growth potential to the extent that outside sources, i.e. taxable brokerage account, are used to pay the taxes on the Roth. To better utilize the IRA owner's unified credit, it's not a huge issue right now. It could be again, depending on who wins the presidency. To effectively reduce the taxable estate to the IRA owner. My man Bob Keebler talks about this in detail in this about 10-page, 20-page paper. Now right here, in subsequent client experiences, we observed a new reason to convert to a Roth IRA, to hedge against projected tax increase when a first spouse dies. And this is the premise of my whole thing on the widow's tax trap. To hedge against the projected increase in tax rates when the first spouse dies. All right, let me keep going forward. The many variables with a Roth conversion lends itself to the development of several spreadsheets. Nevertheless, we have generally found the following key factors need to be identified and addressed in order to best analyze a Roth IRA conversion. You got all these things right here. We're going to talk about these 4 down here, though. So these are traditional IRA balance time horizon, future and cash flow needs, whatever. But we're going to talk about these 4 There are 4 types of Roth conversions that you can isolate to see if it's more beneficial to you. And I'll put a link to this article in the show notes, by the way, so you can look at it yourself. Number 1, strategic conversions. Take advantage of a client's long-term wealth transfers. We're going to talk about this. 2, tactical conversions. Take advantage of short-term client-specific income tax attributes which are set to expire. Again, we'll talk about it. Number 3, opportunistic conversions. Take advantage of short-term stock market volatility, sector rotation, and rotation in asset classes. So right now, these are all the other things you can look at: asset mix, cash flow, future tax rates, and all that. Right now, though, we're just going to look at the 4: strategic conversions, tactical conversions, opportunistic conversions, and finally, hedging conversions. Take advantage of projected future events which will result in the client being subject to higher taxes within the near future. All right, so my man Bob starts with a strategic conversion. An ideal strategic conversion candidate would be a client who has outside funds to pay the tax on the conversion, will not need the Roth IRA to meet annual living expenses. Essentially, is wanting to leave it to his heirs or grandchildren, so he desires to leave a tax-free asset to heirs or grandkids, and expects to be in the same or higher tax bracket in future years. In this situation, the Roth IRA is viewed more as a wealth transfer tool rather than a retirement income vehicle, because Roth IRA owners are not subject to RMD rules. The funds within the account are allowed to grow tax-free over a period of years. This growth can be exponential. All right, a couple things. Then he says right here, thus the Roth IRA is the perfect retirement asset for which to transfer the greatest amount of wealth. Just be advised, in 2014, the Supreme Court unanimously ruled against IRAs and Roth IRAs being free from creditors. So just keep that in mind. So while that was true before, that the Roth IRA and any IRA, stretch IRA to the non-spouse beneficiaries gave you some exposure, some estate planning exposure. That way you would not be subject to lawsuits. Those days are gone. They certainly are subject to creditors now for lawsuits for your non-spouse beneficiaries. So then he gives a bunch of examples, and I'm not going to go into here too much of the examples. A couple I will. Another critical factor in analyzing strategic conversions is the ability to use outside funds to pay the income tax. I could not agree that more. And he talks about Elizabeth here. And so basically by doing Roth conversions, she nets another 4.74% to leave to her heirs tax-free. I'm not going to get into all this in this stage. You can if you want to, for sure. Let's keep going down. Lots of charts here. I want to go to page tactical conversions. Let's talk about tactical conversions. So remember, strategic conversions is you're strategically wanting to pay the tax today to leave a tax-free asset to your heirs. That's essentially what's going on. You're saying, I think I'll have a lower tax to me, and I'll avoid a higher tax in the future to my heirs. Tactical conversions, though, adhere to the same principles as strategic conversions, except that a Roth IRA and these types of conversions is used as a tool to realize short-term, unused special tax attributes, such as net operating loss carryforwards, NOL carryforwards, business and other ordinary losses, deductions and exemptions in excess of income, charitable contribution carryforwards, and non-refundable tax credits. In a typical tactical conversion scenario, the client is faced with the possibility of losing a favorable tax attribute within the current year or the near future. In order to realize this favorable tax attribute, the client must generate taxable income. Thus, in this case, the client uses the Roth IRA to free up the unrealized favorable tax attribute, while at the same time virtually paying little to no income tax on the Roth conversion. And what he gives us now is Tom and Mary Smith had the following sources of income: deductions, exemptions, and credits. $3,000, you can see $8,000 interest and qualified dividends, $12,000 long-term capital gain. Partnership income, they had $30,000. NOL carryforward, net operating loss carryforward, is $100,000. Itemized deductions, personal exemptions, lifetime earning credits, you can see all that. So essentially what's going on here is they had no income tax at all. And if we keep going down here, knowing that they would have negative taxable income in 2007, thereby not being able to utilize the non-refundable college tax credits for the 2 children, Tom and Mary asked their CPA to determine how much they can convert to the Roth so as to realize the full amount of these credits. Based on these facts, their CPA determined that they convert $120,000 to the Roth IRA. And so now look, They got 100,000 net operating loss carryforwards, but because of their personal exemptions and itemized deductions, and now they're able to use the credits as well, education credits of $36.50, they only have $78 in income tax. I cannot stress how important this is. I'll never forget I had a client, a couple back years ago, in one of these RIAs that I was working with, and the client had for a number of years no income tax at all, none. They weren't 70 years old yet, but because they had significant losses, I think they had passive rental properties that they could write off. They had no income tax, but they had this big fat IRA. And I'll never forget this. Said, what's going on here? You got no income. Why are we not pulling money out of our IRA? I don't care if you do Roth, but why are we waiting for those losses to be expired? You're wasting this loss. I'll never forget that. And I was screaming bloody murder at their tax guy. I was like, dude, what the hell is going on? And the tax guy's like, I leave it up to you guys, the financial advisor. And the financial advisor was like, we don't do tax advice. And I said, this is the whole point about the business. No one's coordinating with these people. So they have these huge passive income losses from the rental properties, no taxable income for like 3 years running. On top of that, they're only 68 years old. There's no RMDs. And on top of that, those passive losses will be gone because you only depreciate so much and all that. By the time RMDs come, they're going to have huge income. I could not believe it. It infuriated me. And so I said, you guys need to start moving money out of this thing. Come on. Opportunistic conversions. An opportunistic conversion is another type of tactical conversion that takes advantage of short-term economic conditions which are expected to reverse over time. A classic example of this would be a situation where the client's IRA portfolio has languished recently due to market correction, but is expected to turn around within the next year or two. Another example of an opportunistic conversion would be a situation where the client's IRA portfolio holds a stock or a fund that is expected to have rapid growth within the near term. I just share this story a million times on Sunday, but I'll never forget. It has a guy in Long Island, New York, and the market just got hammered. I think his 1.5 million portfolio is down $1 million. And this is in 2010. And he wanted to convert the whole thing. He goes, I just think the market's going to come back around, and I just want to convert the whole thing. I said, man, it's going to cost you an arm and a leg. Back then, we were worried about the estate tax in New York State. We were worried about the income tax because the income tax was going up, if memory serves, and we were worried about the state tax from the federal one as well. So essentially, he was trying to reduce his estate, like my man Bob was talking about here earlier. Sorry, I keep doing this thing. It's just rubbed up against my neck there. Anyway, so he did it, and he had $1 million. We converted. I think it cost him $350,000, which he paid out of the IRA. So he was sitting on $650. So a year and a half ago, he had a $1.5 million. Now it's sitting on $650. That sucker is probably worth $2.5 million now. Would it tripled, went up 8-9% a year, something like that, the last 10 years. So $630,000 at 8% a year, 9% a year. Well, no, it's 13.8% is what the S&P 500 has done. So $650,000. I'm just off the top of my head. Is present value. We'll just say 14% year-over-year growth, 10 years, zero payment. That guy's worth $2.4 million tax-free now. I mean, not only did none of that's taxable. None. It's crazy. So he timed it right. I mean, it could have gone the other way, but he timed it right. This is my favorite. This is where I got the widow's tax trap. Hedging conversions. As the name implies, a hedging conversion is a type of Roth IRA conversion done to hedge against some future event that would result in higher taxes. In a nutshell, there are two main types of hedging conversions: income tax conversions and estate tax conversions. An income tax hedge is a hedging conversion which hedges against the likelihood of higher income tax in the future. A typical income tax hedging conversion scenario would involve the married couple where one spouse is expected to die within the near future. In this situation, in the year of death, the deceased client and surviving spouse file a joint income tax return. However, going forward, the surviving spouse will file a single income tax return. Assuming that the surviving spouse has the same taxable income in the future years as when the client was alive, she will have to pay more income tax because now she is filing single. On the other hand, had the client and the surviving spouse converted to a Roth IRA in the tax years before the client died, they would more likely have saved income tax. And and my man Bob doesn't talk about it here, but just as a shameful plug for my book, Tax Bomb and Your Retirement Accounts, not only is the tax rate higher for the surviving spouse, and the income is lower, so she makes less money because she loses at least one Social Security, if not a portion of the pension and whatnot. But she loses income, but she pays more in income tax. It's nuts. But then on top of that, Medicare premiums, the whole thing I talk about, tax on qualified dividends, tax on long-term capital gains, more tax on Social Security in a higher tax bracket. Just the thing's just nuts. And so Bob doesn't talk about that here. But again, you want to take advantage of a married filing jointly status to make sure your surviving spouse hedges the taxes that are coming down the pike. He gives a couple examples, which I won't go into here, but you certainly want to read these for sure. All right, let's keep going down. Let's talk about here. Now we got like an income tax right here. So like an income tax hedging conversion, an estate tax hedging conversion hedges against the possibility that the combined income and estate tax on a traditional IRA will be higher than converting to an IRA. In the context of traditional IRAs, qualified retirement plans, and Roth IRAs, the gross value of these accounts will be included in the decedent's gross estate. However, even though these accounts are included in the decedent's gross estate, so remember, IRAs, Roth or otherwise, are included in the decedent's gross estate, as is life insurance. They will not receive a step up in basis because they are deemed to be IRD, income with respect to a decedent. Because traditional IRAs and other qualified plans are items of our IRD, the Internal Revenue Code assesses an income tax on distributions that occur after the account owner's death. In these situations where an estate tax has been imposed upon the same funds that are subject to income tax, an income tax deduction for the federal estate tax paid on IRD is designed to help mitigate the effect of double taxation. This is commonly referred to as the IRC Section 691 deduction. Even if a client expects to be in the same income tax bracket in the future as she is today, it is generally better for the client to convert to a Roth IRA and pay the income tax on the conversion. At first blush, this might not seem logical. However, when you factor in federal and state estate taxes, the reasoning for doing a Roth becomes even more evident. Under general mathematical principles, it would first appear that doing a Roth conversion prior to death would not have any impact on the client from an income tax perspective. This would be true if federal income tax deduction were allowed for the entire amount of estate taxes, both federal and state, paid on the traditional IRA. Again, that's called IRD. However, the federal tax law does not allow an income tax deduction for any state estate taxes paid on IRD. So for you all living in a state that has an estate tax, looking at you, Massachusetts, looking at you, Oregon, you cannot deduct IRD. So because of that, you're better off paying income taxes while you are alive as opposed to your estate paying it in order to pay estate tax. Because of this, the taxpayer is losing a part of the IRA balance to state estate taxes for which the beneficiaries are not receiving a corresponding deduction on their income taxes. Conversely, the client's estate would be allowed an estate tax deduction for all income taxes. You get to deduct all income taxes, but you don't get to deduct all estate taxes. You get to deduct both federal and state income taxes paid prior to death, but you cannot deduct state estate taxes. Accordingly, it is more tax efficient to incur an income tax before incurring estate tax. I hope that makes sense. And again, my man Bob's got tons of examples here. This used to be a strategy I love, the Roth IRA segregation conversion strategy. We can no longer do that because of the Trump tax code. The one law about the Trump tax law I did not like was getting rid of this because I loved it, man. No one was talking about it. Oh, it's too bad. That was a fantastic one. Let's see. Determining the proper amount to convert. The key to the optimum conversion amount will depend on the client's current and future projected income tax rates. As discussed earlier, to the extent that the client expects the future rate to be the same or higher than the current tax rate, little harm can be done by converting to a Roth IRA. In many cases, a client will be in a higher tax bracket in the future. The primary reason for this is that upon reaching the age of 70 and a half, RMDs must come from the traditional IRA. Depending on the size of the client's traditional IRA and other income generated outside of the IRA, taxable dividends and interest, Social Security, the client will most likely be in a higher tax bracket once RMDs begin. Thus, in choosing the optimum amount to convert to a Roth IRA, the client will most likely convert an amount which will be taxed at a rate that would be the same or less than the projected tax rate. And again, more examples from man Bob. And then he talks about stretch out considerations. That's not a start a deal anymore. And what I mean by that is the stretch IRA stuff makes sense. They're going to get rid of that. There's going to be new Congress that gets rid of stretch IRA. I guarantee. I don't know if it's going to be next year. If Bernie Sanders, I guess he probably won't win, but let's say Biden, whoever comes, I think Trump will get reelected. But at some point, there's going to be a bipartisan law probably to get rid of the stretch IRA. So I'm not hugely keen on offering that as a pay taxes or now to have tax-free multi-generations. I do think it's still out there for sure. I just don't think that should be first and foremost in your tax planning. Even though it's still there, it is absolutely available. If I leave something to my kids, they can take the IRA tax-free over their life expectancy. If I leave something to my grandkids, which I don't have the fortune of I don't have the blessings to have any yet, 5-10 years now, they can also take it over their life expectancy under current rules. I just don't see that going forward. So even though it's a wonderful, wonderful thing, don't get too caught up in the life expectancy stretch IRA concept. There's many more benefits to the Roth conversion strategy that we went in here today. As always, you like what you see, smash the like button. It helps the algorithm. So let me know. Has this been helpful? Put in the comments, yes or no. This might be confusing. I get it. I will link to the show notes with all Bob's numbers and everything. I don't even know where Keebler's at. He's got his own firm out in Milwaukee, if memory serves. But Robert Keebler, CPA, is the guy. So look him up. Smash, share, comment. So just put yes or no. This was helpful. I'd appreciate that. And we'll see you next time. Thanks now.